Welcome everyone to Team Wealth Live with Matt Sorensen. Excited to be here today. Today, we're talking about my favorite topic, self-directed IRAs. We want to give you the insider's guide today. I'm going to go over what the self-directed IRA is, what the opportunities are. Then we've got a lot of questions that have came in over the last couple of weeks about how to self-direct, what you can and can't do, what are the good assets, some problems and issues people have ran into. We're going to hit all those questions. So thanks to everyone that has submitted those. You can submit those at my website, by the way, mattsorensen.com. I even have some voice recorded questions we're going to get to later in the day today. But first, I want to set the stage and make sure everybody understands what is a self-directed IRA. I know some of you watching are like, Matt, I've been doing this for 10 years. I'm a pro. I know what it is. Get to the questions already. I'll get there, okay? But I want to make sure anyone new watching this gets the vision of what a self-directed IRA is. Here's what a self-directed IRA is. A self-directed IRA is an IRA. This could be Roth, traditional, SEP, even a solo 401k or HSA. It's a retirement account in general that can invest in any asset allowed by law. You're not just restricted to a stock, bond, or mutual fund. It's like if you have an IRA with a broker-dealer, what can you buy with that IRA account? Broker-dealer products, stocks, bonds, and mutual funds, all right? But that's not what your IRA is limited to. That's just what your IRA is limited to when you have it with a broker-dealer. So if you want to self-direct, so to speak, and you want to buy the common assets people self-direct, real estate, rental properties, multifamily syndication, small businesses, private lending, crypto. If you want to invest in those assets with your IRA, you can do it. You've always been able to do that. It's not like there's anything new in the tax code. You've always been able to do that. You just can't do it at a broker-dealer IRA. You need to use an IRA provider that's a self-directed IRA custodian. And that's what my company, Directed IRA, does. I wrote the #1 book in the field on it, the Self-Directed IRA Handbook. Guys, we open 50 new accounts a day for people who are using their IRA or retirement account money to invest in assets like real estate. They're buying the duplex down the street. They're investing in a small business in their community. They're investing in the next startup. They're investing in a private fund to do a bigger real estate deal they couldn't do on their own. These are all things you can do with a self-directed IRA. So now to get there, if you have an IRA at Fidelity or TD Ameritrade and you're like, well, I don't want to buy any more stocks, bonds, and mutual funds. I want to move the whole thing or a piece of it. I don't want to do a real estate deal. I want to invest in a small business. I want to invest in a startup. I want to invest in a private equity fund. You can do this. These are all assets allowed in your IRA, but it requires a self-directed IRA custodian like the #1 company in the space, Directed IRA. That's what we do here every day, and that's what we're helping clients do across the country is use their retirement account dollars to invest in the assets they know and they believe in. And why are people doing that? Why are people doing a self-directed IRA? There's one reason why. They want to have a bigger retirement account later in retirement, right? They believe that by taking control of it and investing in assets they know, getting off the stock market that's overvalued and volatile, I mean, this is the mindset and thinking, that they'd rather believe in hard assets and small businesses and real estate and assets they believe in that are going to grow and appreciate over time and create better return when they hit retirement plan age than being fully invested in the stock market. So that's what people are doing. They're investing in these quote unquote alternative assets with their retirement account. All right, now there's a couple things you need to know when you do that. First thing is you need a self-directed IRA. So you need to move your money, which is not taxable. You can have a Roth IRA that's self-directed, a traditional IRA, a SEP IRA. It's the same thing that you have at TD Ameritrade or Fidelity or Schwab. You're just at a company like Directed IRA where we don't restrict you to broker-dealer products. So now you can go out and make that investment. So let me give a first example here, and this is a property. I bought a rental property, okay? I bought it for $85,000 with my retirement account. It created $950 a month in rent. This is a rental property in Indianapolis. And then I sold it 5 years later for $184,000, okay? I made $99,000, excuse me, I made $99,000 in gain on that property. I also had rental income during the time I owned it, but that all went to my retirement account and it grew my retirement account, not paying tax on the income, on the rental income or the gain when I sold it. It's all building up in my retirement account. And so the same thing like when you're buying a stock and you're getting dividends or you sell the stock for a gain and that goes into your retirement account, it works the same for non-publicly traded assets, whether it's real estate, small business ownership, or even private lending, which is another thing that I do with my account. Now, these are all assets that you can buy with a retirement account. Real estate, whether it's a rental, you can lend to other people with your retirement account. That's popular. You can invest in an LLC or private fund with others. These are all totally assets possible with a retirement account. Now, we're talking about investment assets, okay? When we're thinking about investing your IRA into real estate, this is for an investment property, whether it's a long-term rental, a short-term rental, or you're gonna flip it. This is land or a property you're optioning or you're wholesaling a property. They're all investment assets. We're not buying a home that we're gonna live in, okay? That violates the rules for IRAs. Also, when you're investing in businesses or companies, we're not investing in your business or company, okay? There's rules called prohibited transactions that restrict your IRA from investing to you or to a company you own a majority ownership of, or anyone who's disqualified under the rules. So we're talking about investing in other people's businesses and companies we believe it's going to grow and expand, and that we want to have a great return for our IRA and that we think is better than investing in the big company that's already publicly traded. All right, so we're buying these alternative assets with our self-directed retirement account. That's the concept. We're hoping these accounts are going to grow and be bigger once we hit that retirement. So we have a freaking retirement we're looking forward to, not one we're dreading. All right, now I want to get to everyone's questions here. I want to set the stage there and give a quick little Reader's Digest version on what the heck is a self-directed IRA. We're going to take some live questions here. What we're going to do in the second half of the show today is I'm going to hit general wealth building questions. I got a lot of those on tax and legal planning. You know, I'm a lawyer, a wealth lawyer, been a lawyer almost 20 years now, coming up on 20 years here in just a few months. And so I've done 10,000 plus consults helping clients do this. So I'm going to give my perspective on some of those general team wealth building questions towards the back half of the show. But for now, we're going to focus on the self-directed questions because I got a lot and you guys know I freaking love that stuff. Okay, so this is a question that came in from Allison Teo. She asked, "Hi, Matt, really appreciate your content. Do I have to create an LLC if I want to invest in real estate with my IRA in the US?" Okay, Allison, you don't have to. A lot of people who buy real estate with their self-directed IRA, what they'll do is they'll have their IRA own 100% of an LLC, and then the LLC will have a bank account. The IRA invests its cash into the LLC bank account. The LLC in turn owns the property. The rental income goes to the LLC bank account. When they sell the property for a gain, it goes back to the LLC. Now, the IRA owns the LLC. You don't own this LLC. It's a unique LLC that your IRA owns. We do this structure common. My law firm, KKOS Lawyers, sets up those LLCs. Now, that LLC is going to cost you $1,200. Okay, it's expensive. You got a state filing fee. I shouldn't say expensive, but there's a cost to it, right? And so, but it provides that checkbook control because you're going to have control of the LLC checkbook. You'll have a debit card that you can use for the property or the investments. And obviously, that LLC bank account is going to receive the income. So that's the IRA LLC. Some people call it a checkbook control IRA. We got separate videos on it to learn about how that works. We'll make sure we drop them here live. We'll provide a link to everyone. It's a whole chapter in my book. We got webinars and full podcasts on just the IRA LLC structure. It's a cool structure. It's very popular for real estate investors using a self-directed IRA. But to answer your question, Allison, you do not have to use it. You don't have to. If you're just buying a rental property, we have lots of clients who don't use the LLC. Now, what you're going to want to have if you do that, though, is a property manager. Because what happens when you own a rental is there's a lot of administrative stuff. The rent comes in, the property taxes need to be paid, the utilities need to be paid, a handyman needs to come over, needs to get paid. You don't want to be doing this out of your IRA, submitting a form to your IRA custodian, whether that's us at Directed IRA or anyone else, saying, "Oh, hey, pay that bill. Oh, I approve that expense. Oh, did the rent come in? Oh, the tenant didn't pay. I need to go collect." You do not want to go back and forth with your IRA custodian for that. There's fees involved in that, no matter whether you're a Directed IRA or anywhere else. And it's also just an administrative hassle. You have to work through your IRA custodian when your IRA owns a property directly. But you can have a property manager. I've done this with my own retirement account. I use an LLC, but I had a property manager too. And that property manager manages the rent, makes sure the expenses are paid on the property, and then just sends you the cash flow to the IRA directly. So that would be option 2, Allison, for you. Now, if you're going to buy properties and hold them significantly, or you're going to acquire a bigger real estate portfolio, I would look at doing the IRA LLC, but not a requirement. And we definitely have clients that own real estate in their IRA directly. Most of them are using a property manager. All right, question here from Amp the Game says, "Can I use my funds in the IRA LLC to help with a startup that my girlfriend will own? And what happens if we get married? Will it end up causing a prohibited transaction?" Okay, great question. So this is someone that has a self-directed IRA that owns an LLC, the structure I just mentioned a minute ago. You can use that account to invest in a startup that's owned by your girlfriend. I freaking love that, actually. But what the question's getting to here is something called the prohibited transaction rules. What the prohibited transaction rule says is that your IRA cannot invest or it cannot transact, buy ownership, lend money to, sell assets. It can't transact with someone who's called a disqualified person. And the disqualified persons under the list include you, the IRA owner, your parents, your kids, and also your spouse. So what Amp the Game's asking here is that going to cause an issue if we do get married later? And the short answer to that is yes. If she just stays your girlfriend and maybe you want her just in the friend zone, the girlfriend zone, I guess, and not like, to marry, you're going to invest your money with her, but that's totally fine. But if you guys get married and your IRA is still invested in her business, it could cause issues of a prohibited transaction. Now, we haven't seen cases on that. We've definitely ran across this situation where it's happened. My advice, if that does happen and you want to get married, is don't change the deal. If the IRA invested in about 20% of the company for putting cash in, don't have it buy more shares once you're invested. Don't have it sell the shares to her, who's now your wife, or anything like that. Sell it to a third party. Obviously, it could get the dividends or the profit coming out of the company if there is some. So just be careful. I would say proceed with caution there. That would be a yellow light. And you may want to get separate advice from an attorney on that. Our team at KKOS Lawyers can help. But that's the general framework of what I would think about there. Okay. Jody asked, hello, Matt. Is it better to cash out one of my 457 accounts later this year, pay the taxes, and roll it to a Roth to purchase property? Or is it better to use the full amount for better leverage and pay taxes later? Okay, great question. You can use a 457 account, which is traditional funds. This is pre-tax traditional funds. So if you move that to a self-directed account, that would be a traditional IRA. Now, the thing with traditional accounts is, one of the differences of a traditional Roth is when you have a traditional account, when you put the money in, you got a deduction. So when Jody put money into her 457 account at her employer, she got a tax deduction. A 457 is kind of like a 401k for a government or nonprofit entity. And so in the 457, she was getting a tax deduction as she was putting the money in. And as her company that she worked for maybe did some matching, it wasn't taxable income to her. And so that money was never taxed. It's called pre-tax or traditional dollars. Now, Jody can move that to a traditional IRA, which she can self-direct, go buy real estate or any alternative assets she wants. But that's traditional funds. It's going to grow. And when Jody pulls the money out in retirement, she pays tax on the way out. Now, a lot of people self-direct traditional accounts. We love Roth accounts that are tax-free on the way out, but a traditional account is still very popular because you built it up, it's tax deferred, you got deductions when you put the money in, and your goal is to grow it to be as large as possible. Then you pull the money out later in retirement as you need it. Maybe you're in a lower tax bracket at that time where the tax is minimal or can be minimized at least. And so that's the thinking on the traditional account. Now, Jody's asking, I want to change it. Is it better to go Roth? I will send that money to a traditional IRA, but I want to convert it so it's Roth dollars. Now, let's say that account is $200,000 and Jody does that. She converts $200,000 of traditional IRA to $200,000 now of Roth. Now, if Jody does that, she has to take into income that $200,000. Her IRA custodian, directed IRAS, or where you're doing this at Fidelity, anywhere else, we're going to send you a 1099-R for $200,000 because you converted a $200,000 traditional account to a Roth account. Now, the benefit of why Jody would do that is that money now gets invested and it grows and it's going to come out tax-free at retirement. As Jody's pulling this money out, this $200K plus all of the investment growth, let's say it gets to $800,000 by the time she wants to retire, that $800,000 comes out totally tax-free. But she's got to pay the IRS now. If Jody converts this in 2024, on her 2024 tax return, she's going to have to include that $200K into annual income. Now, let's say she's in a 30% federal tax bracket, 5% in her state. That's going to be $70,000 in taxes to convert the whole 200. Now, Jody's question asks, is it better to leverage the full amount and pay the taxes later? Now, first of all, I want to make sure nobody does this when they convert to Roth. Don't convert and pay the taxes on the converted amount. If you convert $200,000, you're like, well, I want the money to come from the IRA to pay the taxes. So actually, let's take out that 70 there, and I really only have 130 in a Roth. If you take that 70,000 out to pay the IRS, you're paying a 10% early withdrawal penalty, and you're taking it into your taxable income. We do not want to do that. Okay, do not do that. Instead, what we would recommend is pay that taxes outside the IRA from other non-IRA funds. Even get on a payment plan with the IRS if you have to pay it over time. Do not raid the retirement account, take more penalties to pull the money out and pay. We want to get as much Roth dollars in there as possible, so use outside funds, if you have them, to do the Roth conversion. And sometimes this takes planning. Sometimes you may want to convert a piece of it now, maybe half of it in 2024, and the other half of it January 1st, 2025, to break it up over 2 tax years to make the tax burden a little less. So, is it better though? This is a tough question, Jody, because it really depends on the investments. And every time we ran an analysis, and I'm going to do a later video on this, on when to convert to Roth and when not to convert to Roth. If you're going to get 5% returns, Jody, on your money, and let's say you're 50, I don't know all the details, everyone's scenario is different. If you're in your 50s or 60s, let's say, and you're like, should I convert? And if I'm going to grow my account at a 5% rate of return, my answer is like, nah. It depends on what your tax bracket is now, what income bracket you're in, where you're going to be at retirement, whether it's a better decision to convert now. And it might not be a crystal clear answer of like, definitely you should convert. But if you're like, I can get 10+% returns over a 20-year window, maybe you're in your 40s or you're in your early 50s, not planning to touch your account till 70, and you got a 20-year window to work with, converting 200,000 now and paying tax on 200 grand, which will cost you 70,000 now. And that's 70,000 you could otherwise invest. Don't get me wrong. I'm not missing that 70K out. But if I can get a 10% rate of return on that 200K, and it's going to grow and turn into, let's say, 800,000 or $1 million at retirement, which is totally possible over a 10, 20-year window to grow that account at that rate. If I'm pulling that out of retirement, that whole amount, that $1 million is coming out totally tax-free. I'm paying 0 tax on it, as opposed to paying 35% on the way out there on $1 million, where I'm paying $350,000 in taxes now. So is it better? Is it not? It really depends. I hate to say that. That's very lawyerly of me, but it really does depend on your scenario. But without a doubt, the greater your rate of return on the investments you can do in the Roth, the greater the benefit is to convert now. Also, the more time you have on your hands to grow the account gives you more ability to compound, and that ability is going to increase your returns as well, which is going to be more tax-free money on the way out. So I'm going to look at the rate of return we think you can get and on the time horizon you have to when you expect to pull the account out. So the younger you are and the higher rate of return you have, the more likely I'm going to say definitely convert to Roth. Okay, let's hit another question. This is from Maritus. Asks, I'm wanting to retire, but I don't have enough in my 403B. I've been a nurse for 30 years. I have an LLC and I'm trying to get that going. I'm attempting some side hustles to keep earning income. I'm afraid to put money into a self-directed account. My limiting belief is that I will not be able to have enough money and will need to keep working, and that self-directing is scary. Please help. Okay, great question, Martise. And this might not be the answer you guys are expecting from me. Self-directing is not for everybody. Not everybody should be self-directing their IRA. I don't think it's for everybody. The best people who are good at self-directing are those who are entrepreneurial, business owners, real estate investors, people who like having control of their retirement account, people who like having control of their decision-making, people who are not worried about the risks. I want you to think of the risks. I want you to analyze the risks, but I don't want you to worry and stress about it. But I'll tell you what also I don't want you to be doing. I don't want you to just be relying on Wall Street and being lazy with your money and putting it in some default investment that carries very little risk, but also has a ridiculous low return. I don't want you doing that either, Maritus. I want you to be smart about it. Now, there's a couple ways you can overcome that limiting belief, and there's a couple ways you can feel comfortable about it. I'll just give you a couple ideas. First, get educated. Just like anything, something you've never done before or ventured into for the first time is scary. I don't care what we're talking about here. Everything new is a little scary, but the more prepared you are, the more educated you are. Hopefully you're listening to our podcast, you read the book, you're watching our webinars, you're coming onto the lives. I appreciate that, and I appreciate this question. So I'm not out there saying as a message, everyone should self-direct. I actually don't think that. There are people I run into that I'm like, you shouldn't self-direct. You don't know what you're doing yet, and I don't want you wasting your money you've saved away because you're not yet ready. But I do believe that everyone can be ready. This is not rocket science. This is like playing a board game. You got to make strategic moves. And there's certainly things that are more risky than others. You could be like, well, I want to go invest in crypto. Okay, well, that's risky. All right. That could be very risky. That's a newer thing. Is it an asset or not? I mean, there's a lot of risk to investing in crypto. You could do that. But you might say, I'm just going to buy a single family rental in a market I'm familiar with, and I'm going to work with reputable people. That's a lot less risky, right? Housing's not going anywhere. And so that's a little less risky. And so there are different assets within self-directing that have more risk versus others. So at the end of the day, what you want to do is think about yourself, get comfortable with what you're doing, but also realize self-directing is not for everyone, but it can be with the right education and preparation. All right, we got a live question, Tristan?
We do. All right. This is from 77 T Adams. If he bought a property in an LLC, can he fund his SD 401k with it after selling it?
Ooh, what was the person's name?
77 T Adams.
Oh, okay, all right. All right, well, you're going to be Adam, okay? That handle probably wasn't available on YouTube. But all right, great question. No. The answer is no, and I'm sorry, there's a workaround here, but a solo 401k is an awesome retirement account structure. It's basically a 401k plan for people who are self-employed with no other employees. Maybe it's a spouse or a business partner in the business. That's okay. You can do what's called the solo 401k, which is a 401k account just for yourself. The reason solo Ks are cool, there's really two reasons why I love them. The first is you can put $69,000 a year into them as contributions. That's right, $69,000. You can put $7,000 a year into an IRA. So new contributions in a solo K can be significant. So for any of you that are self-employed with no employees, the number one account type you should be looking at is a solo K. We're setting those up every day here at Directed. Now, with the solo K, the second reason I love it is you can self-direct it. The solo 401k can be invested in real estate or other alternative assets, the stuff I talked about at the front end here. Now, in order to qualify as self-employed, you must have self-employed income. And this is getting to the question here. If I have self-employed income, that's usually from selling goods or services. But as Adam in the question here has and I know that's not your name, but just roll with me here. And the question says, well, I have a piece of property. I presume this is a rental that's owned by an LLC. Well, a rental property is an investment asset. See, when you get income on a rental property, it's rental income. It's not ordinary income or business income. It's rental income. You don't pay self-employment tax on it. It goes into your tax bracket. When you sell the property, you get a capital gain. Again, no self-employment tax. It's a lower rate of tax. And so Congress is like 401ks are for businesses and business owners or people who have self-employment income. They're not for investment assets. Now, if you have rental properties, and we do have a lot of clients that have rental real estate assets, and frankly, they live off of that portfolio. They don't really have a day job. Maybe they got some side income here and there from consulting or commissions or other things they may do. But their primarily source of income is the rental real estate. Now you can do, and even if it's not, even if you have a W-2 job, by the way, what I'm gonna tell you works here. You can do what's called a side door solo 401k. All right, that's what we've coined this. What we're going to do is we're going to set up a management entity. Let me go to the diagram here. Let me actually show you guys how this works. So you guys know we always do the trifecta in our law firm for clients. Mark and I have developed this over 10 years or so trying to teach clients. Over here, this is our operations. This is your W-2 or your business. This is you working to make money, selling goods or services. On the right side over here, we have assets or investments. Okay. These are our assets that make money for us. We're not working for it. These are our assets. Now, in the example here from Adam, he's got a piece of real estate owned by an LLC. We love that. We like the LLC for asset protection. But the owner of that LLC is Adam here, or the trust. We like you to have a trust for estate planning. There's no asset protection. It's just for estate planning here. But it's basically you here. So now, where can I set up a solo 401k? I can only set it up over here on this left side. This is where now a solo K, once I contribute it, goes over on the right side because it is a retirement account that I invest. But to get contributions in, it needs to come from the left side here, from operations or assets. So if I've got this LLC here, what I can do, and let me just clean that up. I can pay a management fee over to a sole prop entity, or I could set up another LLC over here. And this sole prop entity is owned by me. That management fee becomes ordinary income now. Now I'm going to expense it over here. It's going to increase my loss here. It's going to reduce my rental income, but then it's going to create income over here on my operations side, which I would never do. We would never recommend this unless you're trying to do the side door solo K. Now that I have income over here, I've got self-employment income over here on my operations side. Now I can contribute and have a solo 401k. So that's one way to do it. We have lots of clients that have side hustles. They even have a W-2 at their day job, and then they have a side hustle, and that side hustle qualifies them as being self-employed to create a solo K, and then they're contributing to the solo K off of that side hustle income. So Adam, that'd be your only option here, is the side door solo 401k with one rental property. It's probably aggressive. I don't know how large the rental income on that is. Certainly with clients with a lot more rentals, we've used that structure, but that's just one option for you on what you could do there. All right, any other live questions?
He also had a follow-up. This isn't more of a question, but he said, also, can I get a CPA and counsel from someone in your place? I'm confused on my SD 401k, and my CPA thinks I'm crazy. He's old school, I suppose.
Couple options there. One is our law firm, KQS Lawyers, can certainly help. We have a tax and business law firm representing clients across the country. So you can engage or get one of the lawyers involved there, and hopefully we set up your solo K and you have one already. Include us in that conversation. Or another option, if you're like, I don't like this account. I want to change to one that gets this stuff, that understands self-directing, that understands growing businesses and real estate. Get over to my partner, my law firm partner, Mark J. Kohler. Get over to his website and his Tax Pro network. There's a whole network of Main Street tax professionals. Mark's got over 500 of them in his program that have gone through, gotten certified, that help clients from an advisory or preparing tax returns. So if you get to markjkohler.com, go to his Main Street Tax Pro network, you can find an accountant there. You can search for expertise and search by location. That might be a good place to find somebody. And we'll drop that link in, if we haven't already, into the chat. All right. Anything else you got live? I got some ready to go here.
I do. I got one more live for you, and then you
Okay.
can take off. All right. This is from the Extroverted Accountant.
Awesome.
Is there an issue if the owner of an IRA wants to be the managing member of an LLC that is owned by their IRA?
Okay. Great question. There's no issue as long as it's done right. So I described the IRA LLC a little bit earlier. This is where your IRA owns 100% of an LLC. The LLC goes out and in turn buys the real estate or other investments. You can be manager of the LLC. Now, you're not the member of the LLC. The IRA is the 100% member of the LLC. Member for LLC speak is like owner, stockholder, okay? Member means who owns it. So the IRA owns the LLC 100%, but you as the IRA owner can be manager of the IRA LLC. Manager of an LLC is like president of the corporation. It's who has authority to act on behalf of the LLC. Now, as manager of the LLC, now when the LLC is out making investments, let's say you called the LLC XYZ Investments LLC, you can sign on contracts. So you're going to buy a property, the buyer on the contract is XYZ Investments LLC, and you can sign as manager of the LLC. You need to send a check or send a wire. Well, you're going to be authorized on the bank account as the manager of the LLC. So you can sign the check, send the wire. You're able to really act and control the LLC. Some people call this a checkbook control IRA because you get in control of it as being manager of the LLC. Now, there's a number of cases on this. There's a case called the Ellis versus Commissioner where someone had an IRA LLC and they were manager and they were paying themselves a salary for doing that. That was a prohibited transaction. You can't do that. So don't take compensation for being the manager. And when we set these up in our law firm, we advise clients on what they can and can't do, and we restrict things in the documents. Now, any IRA custodian that allows for IRA LLCs is going to require the operating agreement and the articles for the LLC to be done in a specific way, intending for an IRA to be an owner, with about 10 to 12 different restrictions in the operating agreement of the LLC that's unique from a regular LLC operating agreement. So make sure you're working with a lawyer, a team that understands the IRA LLC and those documents and the restrictions unique for IRAs. But you can definitely be the manager of the IRA LLC. Just don't take a salary, and also don't go work on the properties. If we're buying real estate, don't go work on the property. You can visit the property or show the property to a tenant or tell a contractor what to fix, but there are restrictions on you providing physical work and improvements to an asset like real estate where you're the one doing it physically. So you got to keep a little bit of a distance there. Stick to making decisions, oversight, management, administrative stuff, and you're going to be good on the IRA LLC. All right, extra credit for extroverted accountant on that question. Okay, well, let me get over to some of the questions that came in on the Team Wealth and on my website at mattsorensen.com on self-directed IRAs. All right, this came in from Addie. Addie asked, first of all, love all your videos and thank you for all the helpful content. As a non-resident immigrant who really wants to go the self-directed route, can I move my Fidelity Roth IRA to a self-directed IRA? Yes, you can. You can move to a self-directed IRA at Directed IRA. We even have a team of Spanish speaking here that can help with that. Not that you need it here, Addie, but as a non-resident immigrant, and you can still have an account. Now, with retirement accounts, it's interesting, the rules on that. We have some content on this we've done at Directed IRA on how it works, but yes, it's possible. You just have to have the proper status here in the U.S. And a non-resident immigrant is fine. You probably have earned income in the U.S. that qualifies to make contributions. So we can certainly help there. All right, let's see. Got to get to the next page here. All right, this question is from Julie. Julie says, I'm with a different self-directed IRA custodian. Julie, why do you got to start with that? Julie says, I'm at a different IRA custodian. Hopefully it was before directed IRA was around. And says, but I did a bad loan right out the gate with my self-directed IRA. I've recovered about 2/3 of my principal, and the remaining 1/3, which would include the interest, doesn't seem to be recoverable. The LLC I loaned to is dissolved without my knowledge. The custodian, the IRS, wants proof of this loss, and I really have no way to show it. I don't think I should spend more money trying to recover it, but I don't know what to do to show the loss. I hope someone can answer this. Okay, Julie, great question. And IRA custodians do this differently. There's always different policy and procedure at different companies. I can at least tell you what we do at Directed IRA and try to point in the right direction. What we do is we have a form we use every once in a while like this that's like a special circumstance where we got to write down an asset for a loss. If this was like 10% or 20%, we're not going to run you through the ringer. But, and I even know 1/3, I don't know that's that big of a deal, but if we have someone trying to write more than 50% off of the value of an asset or write it down to zero, what we're going to require is a special circumstance valuation. It's a form you fill out, and I think most companies have this, where you write out what happened, why there was a loss on it, and then provide supporting records and information. In this scenario, I think the fact that the LLC is dissolved or is no longer in good standing is excellent proof of what to go after here and get in terms of documents to show I can't collect on this LLC. It's been dissolved. It's no longer in business. And so I would try that first. I don't know if the owner of this LLC signed a personal guarantee or how your loan documents were, who's on the hook, if it's just the LLC or not. Was the loan unsecured or secured? If there was security on the property, what's the status of that? I mean, the IRA custodian wants to know this. Once they have that information, then they can write down the value based on, what you're deciding to write off. So if you're saying, I'm going to write off the rest of the note that I can't collect and write it down as uncollectible, you're going to want to show documents and records. Every IRA custodian is going to want that in their files because we do get audited and examined by banking departments, and we need to make sure we're following these rules and procedures to properly write down the value of assets. So it's going to come down to documents. Now, sometimes what I've done is sometimes is the easiest for clients, particularly ones writing a value down to zero. They've invested in a company or they've lent money to a real estate investor or startup and it goes to zero. And that happens every once in a while. There's risks at this. What I've told people to do in that scenario is get a letter from a collection lawyer to look at the issue and say, this is not worth collecting or pursuing. This person's worthless. We might be able to sue them for what was invested, but they're worthless and there's no way to collect on it. And so a lot of times you can get that not too expensive by getting some collection lawyer to try and assist. And then that letter can use as some validation for the custodian to write it down. Okay, good question, Julie. Hopefully that helps you wrap that investment up and write that down and move forward.
Okay, we got another question that came through online. I know you might have to wrap this one here, Matt. Just sent in 2553, setting up FMC as I still have a kid. The kid is over 22. Do I set up solo 401k through FMC or just the IRA for the kid? Also,
Okay, the kid is how old?
you know,
22?
that it's it could be 22, but I'm not really 100% sure. There's just a number kind of thrown in there.
Okay.
Also hiring outside family in the next couple of years.
Okay. All right. So tell me they want to do what with the family management company? They want to contribute money?
Yeah. So let me read the question one more time. Just
Yeah.
sent in 2553,
Okay.
setting up FMC as I still have a kid.
Okay.
Do I set up solo 401k PD through FMC or just the IRA for the kid?
Okay. Got it. All right, let me interpret this for some of you guys because he's using a bunch of short lingo here. The 2553 is a form you send to the IRS to become an S corporation. I presume, what was his name?
It's just Nan.
Nan. Okay, I presume that Nan is an LLC and is making an election to be treated as an S corp for tax purposes. It's very common. A lot of people start with LLCs, and there's just sole proprietorships, is single disregarded, going down on a Schedule C on their tax return. Then they'll make an S election to be taxed as an S corporation. We love that strategy. It's a great strategy once your business is starting to make more than $40,000 of net income. Okay, so, and we got separate videos on that, by the way, if that was like, what the hell are you talking about, Matt? There's separate stuff on that. Okay, we got podcast episodes on that. We got a lot of content about when to use an S corporation. So he's filed the 2553 to be taxed as an S corporation. Now, one of the strategies when you do an S corporation is to do a family management company to pay your kids. So let's go to the whiteboard here, and I'm going to just diagram this out. All right, so let's kind of clean it up here, make it simple. All right, here we go. All right, so he's got his S corporation. He filed the 2553, so he's an S corp for tax purposes. Now, there's a great tax strategy we love to do where you can pay your kids from your S corporation and take a tax deduction.
Kid is 13.
Kid is 13. Okay, that helps. All right, kid is 13. So what you can do is if you have an S corporation, you can pay your kids and take a tax deduction, and your kids can take that earned income and contribute it to a Roth IRA or even a Roth solo 401k if you have one. Now, let me go over how this works here, and I'll just break it down. Okay, you've got the S corporation. Your kid in the example here is 13. They're under age 18. If they're over age 18, it's a different structure. But kids under 18 that are working in the business, okay, they're doing something in the business, so you're justified to pay them. Now, you can pay them and you take a tax section. If you pay them $10,000, let's say, that $10,000 is a $10,000 expense to you. It reduces your taxable income 10 grand. Your kid picks it up as income. They're under the standard deduction for tax purposes. They don't even pay taxes on it. They're in a zero tax rate. So it's an immediate win of a $10,000 deduction. Doesn't cost your kid in taxes. Now, the unique thing of paying your kids is you can pay your kids and you don't have to withhold and pay into FICA. You don't need to pay Medicare or Social Security when you're doing that in family-owned businesses. Now, one of the catches on this, though, is that in an S corporation, you do have to do that. However, there's a workaround. So what we're going to do is we set up a family management company. This could just be a bank account or an LLC. Okay, this is Schedule C, sole proprietorship. We pay a management fee out of the S corp over to the family management company. Let's say it's $10,000 is what you want to pay your kid. And I presume your kid's doing $10,000 worth of work here. Then what happens is that $10,000 goes in the family management company, and then the family management company pays your kid. Okay, that $10K goes to your kid, it's outside labor, and that kid picks up the $10K in income. They're under the standard deduction, and they don't have to file a tax return. Now, we got a deduction here in the S corp. The family management company picked up $10,000 of income on Schedule C, but it also expensed $10K back out in paying your kid. So at the end of the day, you got $10,000 of income to your kid. Now, the awesome thing here, what the question's getting at, is your kid has earned income. Okay. What can we do with that earned income? Well, I love just doing a Roth IRA. Just do a Roth IRA and you can put 7,000 a year into a Roth IRA. So the kid's got 10, you can put 7,000 into the Roth IRA. Now that 7 grand can grow. You can start teaching your kid about investing. They can see that account grow over time. And if your kid's 13, doing this for another 5 years, they'll really see a value of this. I mean, you're going to have $35,000 in contributions doing this over a 5-year window, and that account could be worth 60,000 or 70,000 or more. I don't know. It depends on how you invest it and the returns you get. But it's really cool for a kid to see that and appreciate that at a young age. All right. Now, the other option is you could do a solo 401k. Quite honestly, it's a little tricky with a solo 401k because the solo 401k would be set up at the S Corp level. And by the way, if you're doing this for your kids, I presume you've already maxed out your account. I presume you've already maxed out your own solo 401k, your own Roth IRA. If you're high income, I presume you've already done a backdoor Roth IRA. Then we're getting to the kids' Roth IRA. Do not start here doing this stuff for your kids. Take care of your own freaking retirement account first. Make sure you're maxing out your own retirement accounts first, that you have the solo K here going. I presume you're self-employed with no employees, or that you're maxing out your own Roth IRA. If you got a day job, that you're maxing out that 401k to go get the match and the free money. So then we get over to doing the kids' Roth account. All right. We're good on live questions?
No live questions, but we are at 44, so I'm not sure if you want to make your transition to wealth building yet.
Okay. All right. We're going to wrap up there on the self-directed topics, but I'm going to hit all the other topics I got questions on. And what I want to do now, I want to hit wealth building questions that have came in since our last live. I've got a lot of them, and I've got a lot of them. And so let's hit some of those questions that came in. Some of these have to do a little bit with retirement accounts, but not directly on point. All right. So Tanya asked, I watched your recent video where you said you were earning a 16% return, lending your money twice a year. Where are you doing this? Is this through a company like Ignite or individuals? How do I get started? Is there a minimum amount required to get started? I'm 54 and I'm nowhere close to where I should be in retirement funds. Okay. Great question, Tanya. If you're 54, you've got time. All right. You've got plenty of time to still grow and build a retirement account, but you got to get going. The first thing I would say is make sure you're maxing out your contributions right now. So that if that lower amount of money you have that you don't think is enough, you're at least getting more money in to work with and grow. Now, when I talked about getting a 16% return, one of the things I talked about in that video is the rule of 72. The rule of 72 is a calculation that says, how long does it take for your money to double? What's the investment rate of return you need to get to have your money double? And the calculation you use is 72, and you divide it by the rate of return. If I take 72 and I divide it by 16, that's what I'm getting on my money right now annually. That gives me 4.5 years. Every 4.5 years, my money will double. If I had $100,000 and I invested it at 16% annual rate of return, which is what I'm doing right now, in 16 years, that $100,000 will be 1.6 million. Okay, I've done that on previous videos and showed how that works. And that's without making any new contributions at all. But Tanya's asking, well, where are you getting a 16% rate of return? This is an important point. The best returns and the best investments are found. They're not sold. When you ask someone like Ignite or companies that sell loans or notes, they're making money on that too. And they're not going to offer you the full rate of return. You can still get a great rate of return, maybe better in the stock market or mutual fund or other things you've been invested in. But when you're using someone else to sell you loans, you're getting sold something, which is fine. You can make investments by getting sold something, but the best investments are found. They're not sold. And so what am I doing to go find deals where I can get a 16% rate of return? I'm doing a little bit of work. I have a network of people. I have people that need loans for real estate deals. I tell them, I lend my money on real estate deals. Do you want to lend it? Do you want it? Do you need to have a deal where you need the money? It's 12% interest and 2 points for 6 months. You want to extend for a year, it's another 2 points. And if you don't, you pay it off in 6 months. I'm going to lend it to someone else at 12% interest and 2 points. That's how I get a 16% annual rate of return. That's how my money will double every 4.5 years. No, I'm not lending it to just anyone. I'm looking at the deals, making sure the properties are good, and I'm using some other people in my network to help me vet the deals. But I'm being intentional about it. I'm spending the time. I'm doing the work. It's not a lot, but I'm spending my time creating a network of people and I'm letting them know that you do this with my retirement account. That's how I get deals. So if you're proactive about it in trying to find deals, and you spend a little bit of time and effort, you can get a higher rate of return. But it takes you being engaged and taking control of your retirement, not just being sold something on Wall Street. That's what's happening while you're not getting a rate of return when you're buying something on Wall Street. There's 4 other people making money on that investment before you actually put your money into it. Everyone else has got to get paid on that because they've packaged it up, they put it together, they presented it, and they went out and found investors like you who go and buy it. So, Tanya, it will take a little bit of work. Couple of recommendations. Go to your local real estate investment club. Every city has of any significance has a real estate investment group, a RIA, a Real Estate Investors Association in the local area. There's a great one here in Arizona. There's ones all across the country that you can go to. So I would start there. Also start going to events. And those are places where you can go find people that need that money, that are looking for, that have opportunities and deals, but they don't have money. If you have the money, Tanya, in a retirement account, it's not enough to retire on, but you have enough money to invest, you can go deploy those funds to them in good deals where you can get a better rate of return than you could in the stock market. So, so let me take a pause here though, because I want to play some of the questions that we had, the audio questions, because I actually had 2 audio questions on this point. Let's just stay on this for a moment here about how to find deals and opportunities for your self-directed retirement account. That is really a critical point here. And like I said earlier, good investments are not sold, they're found. The most successful self-directed investors I have are people using their retirement account and finding deals and opportunities, creating and making deals and opportunities. They're not waiting for them to come. They're not searching on a website for them. They're out there networking. They're meeting people. They're getting out there. And the more that they do that and the more that they invest, the more deals and opportunities that come their way. And what eventually starts happening is they just start taking the better deals. They get better returns and they keep growing their account faster and faster. It starts accelerating your account when you do that. But it does take a little bit of work. You cannot just be sitting back waiting for these opportunities to present themselves for you. Because you know what? They're not. The only thing that's going to present themselves is something for you to get sold on. So, but go network, go get out there and start finding people where there could be opportunities. Let's take one of these questions. We're going to play this here live. These are some of the questions, by the way. You can get to mattsorensen.com, hit the Ask Matt. You can record your audio question. And I want to play a couple of those here that we have today that are directly on point to this. Okay, this was Albert. Now, Albert asked that question, and I want to play the next one right after this because there's 2 questions that came in for this live, and they're kind of the same question. Albert asking about how do I get into private lending? Now, let's get to Julie's question. Okay, so we've got Albert and Julie there basically asking, how do I become a private lender? I want to lend money to people who have deals. Guys, I was just in an event that I spoke at on Sunday. Yesterday, I spoke at an event called Raising Private Money. Amy Majori, she teaches real estate investors who have deals and opportunities, who have experience. Many of them have done multiple deals. They're looking for investors. There's a whole room of hundreds of them, hundreds of people looking for lenders who want to lend them money. So what you need to do is you need to go where the real estate investors are. If you're someone that wants to lend money to a real estate investor, Julie, Albert, you want to get into private money lending, who is your customer? You need to go where your customer is. Your customer is real estate investors that have deals. You can lend your money on it, charge a better rate of return that you could possibly get in the stock market. You can have it secured on the real property. They're hoping you're out there. Many of the successful real estate investors already have their private lenders lined up. So go to the place where your customer is. Your customer is real estate investors and borrowers who are going to pay you that 12% interest on your loans. Now, another couple of examples to give. Julie, if you're in a small town there, 40,000 people, you can maybe corner your little market there. Go to your title company in your town. There might be 2 or 3 title companies in your town of 40,000. Go to the title companies and say, hey, I'm a private money lender. Who are the real estate investors you guys do deals with? I want to lend them money on their deals. The title company is going to want to connect you with them. These are their customers they want their business from. How can you be helpful to them? Is there a realtors association in your small town, Julie? There probably is. There might be a local group of realtors, or there might be a larger office there in your city that dominates the market. Go to them. Let them know, hey, I'm a private money lender. I lend my money to real estate investors. So when you have real estate investors that can't get funded by a bank, let me help you fund their deal. Why is a real estate agent or a realtor like that? Because they want to sell properties. They want their investor clients to be able to do deals and acquire properties. That's how they get paid too. So start going to where you think the customers are, the real estate investor associations, or the places that are already interacting with your customers, whether it's the title companies, the realtors. Some people of you are in a state where lawyers do the closings rather than title companies. And so you want to connect with those lawyers and attorneys as well. So I hope that's helpful in figuring that out. Now, that's the reason you're going to be out there finding deals that you're going to get a higher rate of return. You're going to find the deals, drive the price. These people aren't going to get funded by a bank where you're competing with the rate of return of the bank. And so you can go out and create your deals and try to get a better return than you could otherwise get. All right, let's go back to some of the other team wealth building questions here.
We also have a couple online questions if you want to ask those.
All right, online goes first. You guys can go first. You guys are here live, so I appreciate that.
Nathan Collins wants to know, does it matter what you call your family management company?
It doesn't matter what you call it. You just want to be very clear. Even like I use this structure. I used to, at least. My youngest daughter just turned 18, so I'm out with the strategy now. But I used it for many years. I just did a sole proprietorship. I just had a separate bank account I used, and I would transfer money from my S corporation over to my separate bank account, and I called it Sorensen Family Management. And that's it. Then it showed up on Schedule C as Sorensen Family Management. That's all I did. Some people set up LLCs for it. You don't have to, but you call it whatever the heck you want. Really, it doesn't matter. It's not like you're marketing this or advertising or anything. It's just going to be on some records, and then on the tax return, you will put the name on Schedule C for this business. So I like just family management, though. I mean, it's pretty clear what it is. The IRS understands what that structure is and sees it, and like, okay, we understand what that was. So that's what I'd go with.
Cool. And then we got another one. This is from Jacob Raymer on YouTube. He said, is Roth worth purchasing real estate when I can use a 1031 outside for tax savings plus taking income now?
Good question. I mean, I like both structures, by the way. The 1031 exchange is awesome. That's where you can buy real estate outside of a retirement account, just your personal money, buy real estate, sell it, and then reinvest the money from the sale into the next property, and you pay no taxes. Now, one of the things we've seen over the years with our clients is we've had a lot of clients do 1031s. I've had over 100 clients that I've talked to that I've helped do 1031s. One of the biggest mistakes I've seen people make in 1031s is they buy a crappy replacement property. They sell out of a greater property, take that gain and roll it into a replacement property, but you have a 180-day window to complete that thing, and you have to identify it in a faster time period. And what I've seen is a lot of clients don't get the right deal in the right time period, and they end up buying a crappy replacement property because they're forced with that time pressure. They don't want to pay the tax, and they want to complete the 1031 exchange. So the benefit on the Roth is I don't have a time crunch to make up to hit the 1031 exchange time period. That money, when I sell the property from a Roth, comes out totally tax-free no matter when. I don't have to, I mean, if I sell a property, I could wait another year until I buy the next property, and there's no tax still. Now, at the downside, and this is as indicated in the question, is the downside to the Roth is I don't get to touch the money now. The 1031, I can touch the money whenever I want. The Roth, I got to wait till I'm 59 and a half. Now, this is a really important point for anyone using a retirement account. When I'm talking about using a retirement account, investing in real estate or other alternative assets, this is your long-term wealth building. I'm not talking about making money for those of you in your 30s and 40s today. I'm talking about building a portfolio and a fortress so you have a retirement you're looking forward to at 59 and a half. This is your long-term wealth building strategy. This is the long-term wealth building tool. And using a Roth is the tax-free, tax-efficient way to do it if you're investing this over time and you can drive great returns. That's what I'm talking about using the Roth. I love using the 1031 as well. So I'm not saying don't do the 1031 and do the Roth instead of it. Do the 1031 for your non-long-term real estate deals. So if you're doing real estate deals on a short-term basis, or you're in your 30s or 40s or 50s and you're like, well, I want the money now or in 5 years or 10 years, that's cool. I want to use it for other purposes. Use the 1031 for those deals and that type of portfolio of assets. So it's not really one or the other. And if you're like, well, Matt, all the 1031s, I'm not trying to use the money, I'm trying to build it up and grow. Cool, do that too. But then there's no difference in the Roth. The Roth is going to come out totally tax-free. Now, remember on the 1031, the last point I'll say on this difference between a Roth and a 1031 is when the money comes out of the 1031 at some point, you will pay tax. So eventually, if you sell a property, even if you do 1031 5 or 6 times and you kept buying a bigger property, a bigger property, a bigger property, eventually when you pull the money out or any of that gain, you will pay tax on the way out. Now, you could take a debt on the property and that's not taxable. You can kind of strip out equity, but there's a cost to that, right? You're paying a bank back some interest, so there's a cost. So there is still tax eventually on a 1031. So just keep that in mind. Whereas the Roth, you can start taking and have use of that at 59.5 and later, totally tax-free. So in the reality, in my opinion, the Roth is actually more flexible, particularly after 59.5, because the 1031, the only way I get any value sucked out of that where I can use the money is by taking out debt. And of course, there's a bank involved and there will be cost and interest on that debt. All right. Okay, well, let's get to one last question here that I had, and then we'll wrap up. By the way, thank you for everyone being here live. I really appreciate that. I appreciate all the questions that came in. We've had more questions for this live than we've ever had. There's a lot of them I didn't get to. Let me just hit a couple other rapid fire questions, then we'll wrap it up. Now, please get over to mattsorensen.com. That's MATSORENSEN. And ask your questions there. Hit the Ask Matt. You can type them in, or we love it if you record them, as we had from Albert and Julie this week. Okay, question from In My Forces asks, does dividend income from an S Corp count as qualified dividend for tax purposes? No, it does not. A qualified dividend is coming from a C corporation and you get a lower tax rate on that. The benefit of dividend income or kind of net profit out of an S Corp, it's still your regular tax bracket for regular income, but you don't pay self-employment tax on it. And that was one of my videos I shot about how the S Corp worked. I talked about Joe Biden's S Corporation, why he used an S Corporation. It saved him hundreds of thousands of taxes. But it's going to save you on self-employment tax. It doesn't get you to qualified dividend where there is a lower tax rate like C corporations are able to have. Okay, then the last question here, I'm going to finish on this. This is from Rebecca on YouTube. She said, thank you. I'm studying to get my commercial real estate license, but also run an unrelated online blog and an unrelated drop shipping e-commerce site. Do I need an LLC for these different income streams? Do I need different LLCs for these different income streams? Very little in the way of assets, but annual revenue is around 150K. Okay, Rebecca, what I would probably do in your scenario is I'd have one S corporation, because I want the S corporation to save you on self-employment tax, whether that's on real estate commissions, or whether that's on the online blog income or the drop shipping e-commerce income. That's all ordinary income. You will have to pay self-employment tax on it. So we definitely want to use an S corporation. But what I might do is have that S corporation own an LLC 100%, and that LLC will own the e-commerce and the drop shipping business, and we'll have the S corporation be the entity you use for the real estate commissions that'll go directly there. Sometimes, depending on your state, you might have to have a professional corporation, a PC or a PLLC, taxes and S Corp. So that's probably the route I would do. You get over to our law firm, KQS Lawyers, talk to one of the attorneys. They can help structure that, optimize it for your specific situation. And then, but you do not have to have a separate entity for these things. There just might be a reason to have the real estate business income because that has a license and definitely has separate licensing requirements, keeping that entity separate from the drop shipping and the blog. But I like the S Corp and LLC structure using it that way. All right. Thank you, everybody, for being here live with me. I appreciate it. Thank you for all the questions. Please make sure you're subscribed to the YouTube channel. This is where I'm trying to go the most. I'm trying to update content. I'm giving you all the information I know. Well, my goal here is to help you along your wealth building journey, whether that's tax strategies, building your retirement account portfolio, protecting your assets, learning of investment ideas and things people are doing to build wealth in the real world. We'll be back here next week. Look forward to seeing you then.